Welcome to another episode of the Crypto Exchange, a Trout and Pepper podcast focusing on the world of digital assets and payments. As longtime leaders in the intersecting worlds of law, business, and government regulations, our lawyers go beyond the buzzwords and headlines to make sense of the emerging legal and regulatory frameworks for operating in the digital asset and payments industries. I'm Rene McNulty, one of the hosts of the podcast and an associate at Trout and Pepper. Before we jump into today's episode, let me remind you to visit and subscribe to our blog, consumerfinancialserviceslawmonitor.com. And don't forget to check out our other podcasts on troutman.com/podcast. We have episodes that focus on trends that drive enforcement activity, consumer financial services, the Fair Credit Reporting Act, cybersecurity, hot button labor and employment law issues, and more. Make sure to subscribe to hear the latest episodes. Today, I'm joined by my colleagues, Carlin McCrory and Ethan Ostroff, for part 2 of our 4-part series that takes a look back at what we've seen from the world of crypto in 2022, and also what we can expect in 2023. There were many noteworthy events that took place in 2022 related to cryptocurrency. We saw numerous regulatory agencies weighing in throughout the year. This 4-part series will focus on actions and insights we have seen from the CFPB, FTC, OFAC, FinCEN, FDIC, OCC, Federal Reserve, and various states. In this week's episode, we'll be focusing on the Federal Reserve and its research and experimentation on central bank digital currencies, as well as recent regulatory developments with the FDIC and OCC. Carlin and Ethan, thank you for joining me. Let's jump right in. While the Federal Reserve has made no decisions on whether to implement a central bank digital currency, a CBDC, it took significant steps in 2022 toward potential implementation by exploring potential benefits and risks of CBDCs from a variety of perspectives, including through technological research and experimentation. To begin with, for those unfamiliar with a CBDC, Carlin, could you explain what it is?
Yeah, sure, Renee. I'm glad to be back on the podcast. A CBDC is the digital form of a national currency that uses blockchain technology to maintain an electronic distributed ledger, just like Bitcoin and other cryptocurrencies, and exists only in electronic form. In the US, a CBDC would be the digital form of the dollar. So, like existing forms of money, a CBDC would enable the public to make digital payments. And the Fed defines it as, and I quote, a digital liability of a central bank that is widely available to the general public.
Has the Fed decided to issue a CBDC at this point?
The Fed has stated that it doesn't intend to proceed with issuance of a CBDC without clear support from the executive branch and from Congress, ideally in the form of a specific authorizing law. However, on January 20th of 2022, the Fed released a paper called Money and Payments, the US Dollar in the Age of Digital Transformation, which examined the benefits and risks of a potential CBDC. And the paper, which was not intended to favor any policy outcome, was the first step in a discussion on whether or how a CBDC could improve the safety and efficiency of the US payment system.
Now, what were some of the findings in this paper?
So it basically outlined 4 things that would serve the needs of the US. And they said that the CBDC would need to be 1, privacy protected, 2, intermediated, 3, widely transferable, and 4, identity verified.
Could you elaborate on those 4 factors a little bit?
Yeah, first is privacy. And the Fed found that a CBDC would need to strike an appropriate balance between safeguarding the privacy rights of consumers and affording the transparency necessary to deter criminal activity. In terms of being intermediate, the paper noted that the Federal Reserve Act does not authorize direct Federal Reserve accounts for individuals, and these accounts would represent a significant expansion of the Fed's role in the financial system and the economy. So, under an intermediated model, the private sector would offer accounts or digital wallets to facilitate the management of CBDC holdings and payments. The potential intermediaries could include commercial banks and regulated non-bank financial service providers, fintechs, and would operate in an open market for CBDC services. For a third point, with respect to transferability, the Fed found that for a CBDC to serve as a widely accessible means of payment, it would need to be readily transferable between customers to different intermediaries. And of course, that just makes logical sense there. And lastly, as to being identity verified, the paper noted that financial institutions in the US are subject to robust rules designed to combat money laundering and the financing of terrorism. And therefore, a CBDC would need to be designed to comply with these rules. We had a prior episode on BSA AML, so we've discussed that before, but similar thoughts here with a CBDC.
Now, I'm assuming the paper discussed the pros and cons of a CBDC. So, what were some of the benefits discussed?
Sure, Renee. The Fed found that as a liability of the Federal Reserve, a CBDC would not require mechanisms like deposit insurance to maintain public confidence. It also would not depend on a backing by an underlying asset pool to maintain its value. So, a CBDC would be the safest digital asset available to the public with no associated credit or liquidity risk, which is an interesting thought as well. The paper also listed five main benefits of a CBDC. The first would be safely meeting the future needs and demands for payment services. The second being improving cross border payments. The third, supporting the dollar's international role. Fourth, promoting financial inclusion. And lastly, extending public access to safe and central bank money.
Now, were there any drawbacks or risks that the Fed mentioned in this paper?
Of course, according to the paper, one of the main risks of a CBDC is that it could fundamentally change the structure of the US financial system because it would alter the roles and responsibilities of the private sector and the central bank. So the paper noted that a widely available CBDC would serve as a near perfect substitute for commercial bank money. This substitution effect could reduce the aggregate amount of deposits in the banking system, which in turn could increase bank funding expenses, reduce credit availability, or raise the credit costs for households and businesses. And the paper further found that an interest bearing CBDC could result in a shift away from other low risk assets. And what we're talking about here are shares in money market mutual funds, T bills, and other short term instruments, which could reduce credit availability or raise credit costs.
In addition to the paper, the Fed also explored CBDCs through experimentation. Ethan, could you tell us a little bit more about this?
Yes, of course. Happy to be with you, Renee and Carlin, again today. The Fed's engaged in a number of different experiments related to digital currencies. So, starting back in 2020, the Fed launched phase one of a multi year research project that it's dubbed Project Hamilton, that's being conducted by the Federal Reserve Bank of Boston in collaboration with MIT's Digital Currency Initiative to investigate the technical feasibility of a general purpose CBDC that could be used by an economy the size of the United States.
Could you tell us a little bit more about phase one of Project Hamilton?
Basically, they explored the use of existing and new technologies to build and test a hypothetical digital currency platform. The project's first phase produced the research and code, which was released to the public for a high performance transaction processor. And the code is the first contribution to Open CBDC, which is a project maintained by MIT, which will serve as a platform for further CBDC research. Project Hamilton basically aims to inform contributions to the code and inform policy discussions about a CBDC.
Now that phase one is complete, is phase two underway?
Yeah, exactly. The second phase is currently ongoing. It's exploring alternative technical designs to improve the already robust privacy, resiliency, and functionality of the technology outlined in the first phase. Research topics might include things like cryptographic designs for privacy and auditability, programmability in smart contracts, offline payments, secure issuance and redemption, other new use cases and access models, techniques for maintaining open access while protecting against denial of service attacks, and other new tools for enacting policy in the future.
Now, you mentioned that there were a number of experiments going on with the Fed. Could you tell us a little bit more about the other projects going on?
Yeah, the Fed also launched what it's calling Project Cedar, which was the inaugural project of the New York Innovation Center at the Federal Reserve Bank of New York. It's a multi phase research effort to develop a technical framework for a theoretical wholesale central bank digital currency, or a WCBDC, in the Federal Reserve context. In phase one of Project Cedar, a prototype for a wholesale central bank digital currency was developed to demonstrate the potential of blockchain to improve the speed, cost, and access to a critical element of the wholesale cross border payments market, like a foreign exchange spot transaction. Phase one was completed last year, and the related report was released in November of 2022.
Now, what were your main takeaways from the related report that was released?
The report revealed that a WCBDC can deliver faster and safer payments. For example, phase one revealed three key findings that showed cross border payments supported by blockchain technology can deliver faster and safer payments. First, the payments were faster. The transaction on the blockchain enabled distributed ledger system settled in under 15 seconds on average. Second, the simulated ledger network enabled atomic settlement, meaning both sides of the simulated transactions were settled either simultaneously or not at all. This greatly reduces the various risks we've talked about that counterparties incur in the current environment. And third, there were safer and accessible transactions in the experiment. The distributed ledger system design enabled payments on a 24/7, 365 basis and supported objectives related to interoperability by enabling transactions across homogeneous ledger networks representing a variety of financial institutions, including central and private sector banks.
Now that phase one is complete, what is the next steps for Project Cedar?
Phase one revealed key questions and highlighted areas for further research, specifically around ledger platform design, interoperability, and security. As part of its continued WCBDC research, they announced Project Cedar Phase 2, a joint experiment with the Monetary Authority of Singapore to explore questions related to interoperability and ledger design, including how to achieve concurrence and best enforce atomic transactions across different blockchain based payment systems.
Now, what is the main purpose of phase two?
It's intended to enhance designs for atomic settlement of cross border, cross currency transactions, leveraging WCBDCs as a settlement asset. The effort, which entails establishing connectivity across multiple heterogeneous simulated currency ledgers, aims to significantly reduce settlement risk, a key pain point in cross border, cross currency transactions.
Now, Carlin, are there any other experimental projects the Fed is engaged in right now?
Yeah, in November of 2022, the Federal Reserve, through the Federal Reserve Bank of New York, launched phase two of its CBDC development, which encompasses a 12-week pilot program with the nation's largest banks.
What is the purpose of this pilot program?
So, the Federal Reserve Bank of New York, through its New York Innovation Center, will participate in a proof of concept project to explore the feasibility of an interoperable network of central bank wholesale digital money and commercial bank digital money operating on a shared multi entity distributed ledger. This US proof of concept project is experimenting with the idea of a regulated liability network. Ultimately, the idea here is that it will test the technical feasibility, legal viability, and business applicability of distributed ledger technology to settle the liabilities of regulated financial institutions through the transfer of central bank liabilities. The project will be conducted in a test environment and only use simulated data. And the findings of the pilot project will be released after it concludes.
You mentioned that the Innovation Center would be working with the nation's largest banks. For what purpose are they doing this?
The Innovation Center is collaborating with a group of private sector organizations to provide a public contribution to the body of knowledge on the application of new technology to the regulated financial system.
This was phase two of the project. What did phase one consist of?
Oh, right. In general, during phase one, the prototype for a CBDC was developed, which is now being used in phase two.
Okay. So was the pilot program launched based on support from Congress or the White House?
The Federal Reserve has yet to receive authorizing legislation from Congress or an executive order from the Biden administration to issue a CBDC, which we discussed a little bit earlier in the episode. But the pilot program seemed at odds with the Federal Reserve's prior stance on the development of a U.S. CBDC, stating that it would not proceed with the issuance of a CBDC without that clear support from the executive branch and from Congress, as we discussed.
Interesting. Switching gears a bit, there were other federal regulatory developments in the crypto space, specifically the FDIC and the OCC weighed in this year. Ethan, could you tell us a little bit more about these developments?
Sure. So back in August of 2022, the FDIC issued cease and desist notices to 5 companies that had suggested crypto related products were FDIC insured. Notably, one company published an article on its website titled, quote, list of FDIC insured crypto exchanges. Although, as the FDIC noted in its cease and desist letter, the FDIC insurance does not cover cryptocurrency.
Were there any other FDIC recent developments worth noting?
Yeah, in this same space with respect to FDIC deposit insurance, the FDIC issued an advisory opinion to FDIC insured institutions regarding FDIC deposit insurance and dealings with crypto companies.
What were
Uh,
the main highlights from this opinion?
The opinion outlined risks and concerns identified by the FDIC and risk management and government's considerations. So, taking risks and concerns first, generally the FDIC stated it was concerned with the risks of consumer confusion or harm arising from crypto assets offered by, through, or in connection with insured depository institutions. They noted that these risks are elevated when a non bank entity offers crypto assets to the non bank's customers while also offering an insured bank's deposit products. As for risk management and governments, the FDIC stated that insured banks need to assess, manage, and control risks arising from all their third party relationships. As we've heard many times for many years, here specifically calling out those third party relationships with crypto companies. And also stated that in the FDIC's dealings with crypto companies, insured banks should confirm and monitor that these companies do not misrepresent the availability of deposit insurance in order to measure and control risks to the bank, and should take appropriate actions to address any such misrepresentations.
Now, it seemed like this was a hot topic. Was there anything else worth noting regarding insured banks and cryptocurrency companies?
Sure, in April of 2022, the FDIC formalized a notification process by releasing a letter that requires FDIC supervised institutions prior to engaging in, or if currently engaged in, a crypto related activity to notify its regional FDIC director.
What prompted this letter?
The letter says that crypto related activities pose significant safety and soundness risks as well as financial stability concerns. And so, based on these concerns and its powers under the Federal Deposit Insurance Act, wherein the FDIC has established in Part 364 safety and soundness standards for all FDIC supervised institutions, the FDIC issued these reporting requirements.
What does the FDIC intend to do with the information obtained through this?
What we understand at this point is the FDIC is going to review the relevant information submitted by supervised institutions related to crypto related activities and provide what it describes as relevant supervisory feedback directly to the institution as it deems appropriate. So, practically speaking, what this is going to actually mean for FDIC supervised institutions is still an open question.
The OCC also weighed into the crypto industry this past year. Could you tell us more about these developments, Carlin?
Sure. During January of 2021, the OCC conditionally approved Anchorage Digital Bank's application for a national trust charter, making Anchorage the first federally chartered crypto bank in the US. However, the OCC's approval of Anchorage charter was contingent upon Anchorage's agreement to enter an operating agreement which imposed certain BSA AML requirements on Anchorage. In April of 2022, the OCC issued a cease and desist consent order against Anchorage for failing to devise and implement an effective BSA AML compliance program in violation of the BSA and its implementing regulations.
Were there any other items worth noting regarding the OCC this past year, Carlin?
Yeah, in its semi annual risk perspective report issued this past year, the OCC disclosed that it continues to approach crypto asset products, services, and activities cautiously, considering the multitude of crypto related entities that have filed for bankruptcy and the network effects of the contagion generated by their collective demise. So, according to the OCC, current crypto industry risk management practices concerning fraud and custodial services lack maturity. As a result, the OCC has stated that it remains primarily focused on whether banks are engaging in these activities in a safe, sound, and fair manner.
With that, this week's podcast is concluded. Carlin and Ethan, thank you for joining us. This has been a great discussion. As a reminder to our listeners, this is part 2 of our 4-part series. Next week, we will discuss state level regulatory activity relating to interest bearing cryptocurrency deposit products, which were the subject of many enforcement orders during 2022. Thank you to our audience for listening to today's episode. Don't forget to visit our blog, consumerfinancialserviceslawmonitor.com, and subscribe so you can get the latest episodes. Please make sure to also subscribe to our podcast via Apple Podcasts, Google Play, Stitcher, or whatever platform you use. We look forward to next time.
Copyright Troutman Pepper Hamilton Sanders, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman Pepper does not make any representations or warranties, express or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including, without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper. If you have any questions, please contact us at troutman.com.